right, Deal Drop 5 team, thank you so much for being here. I'm super excited for today. I really, honestly, like I'm kind of taken aback with this whole Build Wealth initiative and what sort of happened kind of accidentally that's now picked up momentum and allowed me to bring deals that I'm investing into our community where we're able to kind of expand what buy then build kind of means from buying existing companies that we're operating ourselves to kind of joining together to acquire fractional acquisitions in more institutional grade investments. And what I'm going to share with you today is something that could be one of the best investments I've ever made that we're then extending to a new Build Wealth fund in the energy sector. And therefore, we're calling it Power Play. Okay, so that's what we've got. Listen, I just thank you for being here. I can't wait to get into this. It's been months in the making, okay? So here at Deal Drop Live, we are really gonna have three things today. The agenda ultimately is pretty simple, okay? First, we're gonna just kind of remind ourselves, like, what are we doing with fractional acquisitions? What's the mission of Build Wealth, and how is it going, Walker? Like what are these investments doing, and how do we think about this, and what's the track record that we're kind of building here together? Second is, I just want to share that history repeats itself, and what's happening right now has happened before, okay? And so it's one of these things where we can always learn from the past by taking a minute and looking into similar situations and like how the cards kind of played out so that we can capitalize on those things. And then third, we're obviously going to go into the BuildEnergy deal drop in terms and details. Now, with that being said, I'm not gonna make you wait, like 20 or 30 minutes. Okay, I'm gonna give you a little bit about the deal up front. Okay, so as a result, I always have to start with disclaimer. Okay, and the disclaimer is just like, look, we all need to be adults. When I invest money, I'm aware that I might lose it. Anytime you invest money, you might lose it. You might make money. I don't know. We're going to talk about future projections. Nothing is guaranteed. All the risks in the world exist, but we did everything we can to list them in the PPM. And so, do your own diligence, read everything, just, be an adult and understand that there's no guarantees in life, okay? Life is risk, and we just sort of take calculated risk to do the things that we want to do and have fun. Now, most people don't know this, but I own 183 oil wells. So my wife doesn't know this either, and I know she's not watching right now because she's picking up the kids, so she still doesn't know what you know, which is I own 183 oil wells. Look, obviously I don't, but I do. I own them in a fractional fund situation, okay? And so it's one of these where I started to realize the trends that were happening in this space. And if you know anything about the other deals that we're doing at Build Wealth, it's one of these where I almost called the company something stupid like supply, demand, and balance, because I'm always looking for the opportunities that exist in the private market that allow us to get in there and capitalize on things that other people can't see. Okay, and so what's happening in this space is sort of, it starts with this. Okay, oil reserves, okay, as you're pulling oil out of the ground, okay, it declines by 2 to 5% every single year because there's a fixed amount in each well, right? And so it's declining. And so every year there's about 5 million barrels a day, okay, of production that's required to just maintain flat supply, okay, every year, 5 million. But this has been declining because of like low reinvestment and all the rest of it. And so ultimately, okay, global energy production today is severely supply constrained with no prospect of rapid increases at all. These things take time to build, okay? And so the theory here is that supply is being constrained. Now, demand, we're at flat, which I presume means if AI wasn't invented, for example, okay, then what we have is JP Morgan has come out and said, look, in 5 years, in 2030, there is going to be a 7.1 million barrels per day shortfall just to meet existing demand without any growth. okay? That's what's happening here, all right? Private equity has reduced investment in this area by 87.5%, okay, in a rolling 5-year average from the 5 years from 2017 to the 5 years ending in 2023. Investment is severely down. This is because of requirements to invest in ESG, just sort of like reallocation of funds, and this is the biggest area, okay, where capital comes from in order to build these things, okay? There's a couple of partners in this fund, and the first is Jeff Mahajer and his team at Mahajer Energy Advisors, okay? Now, Jeff is really the sort of like oil specialist, right? I mean, he's a geologist. He's spent 4 decades. He and his team have spent 4 decades in this space doing oil, buying, oil wells and natural gas. And so ultimately, out of these 6 funds that he's run over 4 decades, okay, his average internal rate of return is 50%. That's not a typo. 50. Average IRR is 50%. Okay. Now, I got into Fund 6 with Mahajer and we are currently 18 months in at a 35% internal rate of return. Okay. So these are the guys that we are banking on because these are the people that have spent decades in this space. And because I was in this fund, I actually found Mahajer with their partnership with Aspen. Okay, and this is Aspen Funds. If you've been paying attention to what we're doing at Build Wealth, you know that I've partnered with them on Build Flow 1, the credit fund that we offered that we dropped right here on this stage. And this is Bob Frazer and Ben Frazer, and they are related. And ultimately, I went out there because of what we were doing at Build Wealth and how we were picking up momentum with bringing these different private investment opportunities to our community. And I went out there to actually talk to them about the oil and gas fund and this BuildEnergy fund. And ultimately, while I was there, I was building a credit fund on the side, and I already had a couple of people signed up and whatever. And when I went to visit them, I realized that they had like 24 people in the office, sourcing deals, doing underwriting, passing or not passing. And so I realized like I could just buy then build my credit fund by leveraging their whole infrastructure, which made it so easy. But anyways, that was a side note, sorry. I went there specifically, okay, to talk to them about partnering with them and Mahajer on this fund, which is their Fund 7, okay? So Aspen's track record is also important in this instance. 600 million in assets under management, 250 million in investor capital, and we've got $65 million, okay, in investor distributions to investors. I have gotten a little piece of that, which is fun. Okay, so what is the fun strategy here, Walker? Okay, are you like wildcatting? Are you going like offshore? No and no. Okay, what we're doing is we are buying existing producing wells in non-working interest form. Okay, so we have non-operating working interest and in royalties when it makes sense. Okay, and mineral rights. But the thing is like we're not operating in these. The operators are actually publicly traded firms that are well capitalized, that are in the space that you want to be operating your oil well. Okay, and then as a result, we're doing infill drilling. Okay, this is I want you to like the analogy here in business is organic growth. Okay, so we're not only acquiring the oil wells that we're acquiring because we're essentially doing a roll up in oil wells is what we're doing. We have 70 oil wells currently under a letter of intent that we're going to acquire in this fund. And so we're acquiring these, but then we're doing infill. So our team of geologists, Mahajer and their group, are looking at the land and saying, okay, we can take calculated risks and expand our wells by drilling here and here and here. Okay. Then the fund's mandate is really to maximize total return to the investors. Okay. And that's important in a big, obviously, but like a big part of this is that we have a 10-year horizon in this fund, okay? That's crazy. But one of the things you'll see is that, we're actually buying a lot of the wells we're buying right now are actually from private equity firms who have promised, 3 to 5 year exits to their investors. And so they're having to get out even though it's a buyer's market. Okay, so it's a buyer's market. You saw all the investment in private equity has gone down by 87.5%. That means the market has gotten thinner. That means the competition has dried out, and we're able to buy assets for the cheap, right? Because this is very contrarian to what's popular right now. So 10 years, are we really going to hold it 10 years? Probably not, okay? But the point is that we want our management to be able to make a decision as to when we're in a seller's market, and that is when we are going to sell to maximize investor return. We will reinvest in the first year or two in order to get more wells up and producing in order to cash flow even more for the to maximize total return for the investors, okay? This is a buy then build strategy, all right? Now, I'm going to give you some numbers, all right? Now, you might not be able to see it on this stage, and if so, that's okay. We can make sense of this in the portal, okay? So 2025, this year, we are anticipating that we're going to have $23 million of revenue, okay? And then investor distributions will be zero. We're reinvesting, okay? By the end of the decade, okay, we're going to have 88.8 million in revenue and 29 million in distributions to investors, okay? And if we hold the fund, let's just go to 2032. That's probably what, 8 years out. We're going to break 100 million in revenue and have 30 million distributed to investors, right? And then ultimately, when we exit, there looks like there's $90 million in this base case pro forma, all right? Now, I also added the BuildEnergy I. That's our fund, cash on cash returns, just so you can understand, all right? No money in 2025. 2026, probably at the end, distributions will start. 2027, 15% cash on cash. 25% cash on cash. 35.6% cash on cash, 44.4% cash on cash. The pro forma here at base case states an actual, if it runs the whole 10 years, 30% cash on cash returns while you're cash flowing with like a 6.4x, kind of exit at the end, okay? So, the best diligence that you can do is to have me, okay, a couple years ahead of time, go invest my own money with the same exact team. And that's exactly what I did. I'm in two different entities that I own are invested in this group. And as you can see, 2 days ago, I received almost $8,000 in checks, and the amount of work that I did in this fund is zero, okay? So I hope that for you. But even though I was invested in this fund, and even though I already diligenced the heck out of Aspen, I still brought in my former vice president at Goldman Sachs to help me review all of the underwriting and further expand our level of diligence. And we went deep and hard in a way that you can only do when you're coming in with us as a group to take a big chunk of the fund out. Guys, this is what I did. There is a family office subscription, okay, in this fund that has a $5 million minimum investment. And I took that subscription for us, okay? Why? Because it comes with a 15% discount on share price, okay? And then ultimately, we are splitting the share price just like that, okay? So in other words, 7.5% of a discount you buy the minute your money comes in. So you're making, like, on paper, 7.5% the minute that you invest in this deal. So I think that was pretty awesome. Target annual returns, 26%. In this, I'm assuming that, we're not going to hold for the whole 10 years. Maybe we would, in which case that'd be higher. Exit multiple, 6 to 7%. Target internal rate of return, you're talking 28 to 32%. If they do that, this is what's in the PPM. If they do that, it'll be one of the worst performances of their 40-year career. Just throwing that out there, you make your own decision. Okay, we are going to change gears, but I don't want you to wait for the end of this. If you at any time want to soft commit or start getting into the portal or anything like that, go to our portal, which is buildwealth.investnext.com, or Mike Brown is our investor relations here at Build Wealth, and this is his cell phone number, okay? And so go ahead and call his cell phone number during this call at any time. Get on his calendar. This fund is, just so you know, slightly hung up in legal. We've got another couple of days before we can formally take subscriptions. I think it's going to, honestly, I think it's going to go pretty quick. I think, 10 or 20% of it is already full just from before even right now. Okay, I, at the turn of the millennium, went to the University of Kansas, okay, to prepare for this. And I'm prepared because I studied English literature and religious studies, okay? And so after studying those two things, I did what you would expect, which is I went to work for one of the largest financial institutions in the world at Charles Schwab. And while I was a stockbroker at Charles Schwab, a big part of my job was just to discuss asset allocation, okay, with consumer investors in the public markets, right? And so I would take people's time horizon as well as their risk profile, and then I would essentially tell them, I would advise on which assets that people should kind of go into based on what they wanted to do. And of course, I read the book by our fearless leader at this time, Charles Schwab. And so, he wrote this book, Guide to Financial Independence. It was one of the first books that I read on the stock market, okay? And there was this concept that sort of changed the way that I looked at things, okay, in here. And that was, you're born, right? And eventually we die, of course. But what he did was he said, Walker, in the book, Walker, when you save a dollar, it's actually the first dollar you save, sorry, the last dollar that you're going to spend right before you die. And so when you're saving and your money is compounding towards you, you are growing, you're investing in your future, and your future is moving back towards you. And I loved this idea because the concept was that when they collided, you reached that moment of financial independence. Financial independence equates to freedom. It equates to us being able to spend our time how we want. It equates to us being able to spend more time with our children, work on the things that we want to do, not go to work if we don't want to, write, peace out and write another book, right? Or it's something that you can do, we can do. Why should you listen to me? I don't have any idea, but I've done a few things. I acquired 8 companies outright. I'm in a minority investment in 24 more. I've done 3 startups. I've got 3 exits. I'm founder at the Elite Accelerator Acquisition Lab. I've been inside 100 transactions totaling almost $500 million. I'm now a private fund manager, thanks to you guys. I started the entrepreneurship through acquisition program at the Olin School of Business. I've got my MBA, I was licensed by the Securities and Exchange Commission. I've got every certification that the private market ever offered to my knowledge. And I've just, my work has been published in a lot of places, right? And I wrote the best-selling book on buying small businesses in the history of mankind, the Wall Street Journal, USA Today best-selling book, Buy, Then Build. Thanks. Okay, so after I started my first search in 2004, but ultimately I bought my first company in 2006. It was a book printing company. Later, I bought a distribution company. Later, I bought a manufacturing company. Later, I bought a powder coating company. Then I got into e-com, okay, and I started buying assets there. And ultimately, I started dabbling by buying franchisable IP in the same fractional way that we're now doing it in another way. So I started buying this in IP about mid-decade, okay? But ultimately, the way that I was finding success was by merging this Venn diagram, the intersection of being an entrepreneur and an investor, right? In other words, if I can take my time and my money and put it into a business that I own and operate, that's how I found success. It was not by starting businesses from scratch, okay? That's a different talk that we get into. But this was the recipe that worked for me, right? But the thing is that as I started acquiring all these businesses, at one point I had 6 companies and 3 different verticals, in all over the country with different customers and different management teams and different value propositions and different core competencies and all the rest of it. And at the end of the day, there was this little constraint. Me, I was a constraint. There wasn't more Walker, right? So it's just sort of how do I duplicate myself? This was the problem. I couldn't continue to scale. I owned too many companies, right, ultimately. And so it's just sort of one of these how do I duplicate myself into a blue-haired female? So the way that I thought about it was, well, obviously I can just become the investor, and then I can start using other entrepreneurs, right? So the first step 1 is, hey, I'm going to buy a business and put a manager in, and then you get to live that for a while. Very active investment and a lot of personally guaranteed debt. So ultimately, when I started looking for not managers but other entrepreneurs, okay? And in more of the private equity side, not the venture capital side, because I want things that work, that I can depend on, like wells that are already producing, right? I started to come up with a concept of fractional acquisitions, right? You don't always have to buy the whole pizza, Walker. You can just buy the pizza by the slice, okay? And I didn't make this up, obviously, right? So we all read the best-selling book in the world on personal finance, Rich Dad, Poor Dad. The whole goal is get from this side of the quadrants to that side of the quadrants, and not only own businesses, Walker, like you do, but also become an investor. This is the side of the model where all of the real money is made, right here, okay? I didn't make this up, Rich Dad, Poor Dad. Okay, so capitalizing on the inefficiencies in the private market is what gives entrepreneurs the ability to achieve these outsized gains, right? It's not only investing and spending time and effort, but it's also the private capital market offers these inefficiencies and supply-demand imbalances that we can work in. Ultimately, at the end of the day, that's where fortunes are made. This is it, right? This is the game. So where can we find these investments with market inefficiencies? There's this really awesome title, and it's called alternatives, okay? And alternatives are private real estate, okay? Private equity and private credit, okay? But how can we know that this is the answer? How can we know that this is the way? All right, I'm going to introduce a guy named David Swensen to you, okay? Recently passed, he ran the Yale Endowment Fund, okay? And essentially, he got high returns consistently, all right? So during his 36-year tenure, his fund gained 13.7% per year, okay? Is that what your portfolio is doing, okay? Then he had a dramatic growth in assets totaling $57.5 billion in gains in 35 years, while supporting almost $22 billion of Yale spending. If you went to Yale, you benefited from this man, okay? And so then he had this long-term outperformance where he outperformed every other endowment by 3.4% per year, 35 years in a row, okay? And if you just looked at the standard 60-40 stock bonds public portfolio that we all have, which, as we know, is a very moody investment partner, he outperformed you by 4% per year, 36 years in a row, and that's if you didn't touch it in a down market, which we all do. Okay, so this is called the Yale Endowment Model, okay? And if you read David Swensen's book, you will find out hidden in the pages, and I'm paraphrasing here because I needed to clump a couple sentences together, create portfolios that offer high returns and diversification with non-correlated classes. What did the Yale Endowment Model look like? It looked like this, okay? It was 73% in alternative assets, the ones we just covered. Hedge funds, venture capital, leveraged buyouts, that's buying businesses. Private real estate, natural resources, okay? That's oil and gas and also timber, he called real assets. Then you had, the sort of, 60-40 split, we'll loosely call it here. He had domestic equity pretty slim, but that's interesting. But look, you guys have heard me talk about this. I also often talk about the Tiger 21 asset allocation. This comes out every single quarter, right? This is, you've got to have 20 million of liquid net worth just to get accepted for an interview or whatever, right? And so, here's where they are. They've got 55% allocated in private equity and real estate, okay? And, their real estate assets here, these are not, REITs on the public market. These are privately held, institutional grade real estate assets, kind of like the ones that we've been bringing out in our partnerships with AHM, right? And so where are we, though? Where are we? If we're not in the private markets and you're like me, you spend a lot of time down here 100% in public equities, while you're at work, right? Trying to hope that this thing is going to continue to grow for you as fast as possible. And it's no Yale Endowment Model. We'll say it like that, okay? So there's this big surge happening in private equity as everyone kind of, realizes this, and also because of the Jobs Act. The reason I'm able to do this right now, on Zoom, is because of the Jobs Act and the fact that I can now talk about this and we can go out and get access to these institutional grade investments that used to be reserved for the ultra high net worth individuals. That's it. Now that's changing. Everyone understands, okay, that private assets and private investments are where it's going. And so there's been a big surge in people investing in private equity, probably because they all read Buy Then Build. Anyway, so as I looked at the different strategies I was undergoing, right? Like I started investing in these things in 2013, and then later with conviction in 2019, with discipline and a model. And as I started thinking through the model, I started looking at these different assets and realizing, like, which strategy do I want to actually employ here? Because there's different things, right? So private equity is appreciation, real estate is appreciation, some cash flow, a tax shield, and then credit funds are collateralized income, or actually, like all but eliminating volatility, which is really super attractive. So, I ended up building this pizza by the slice portfolio, right? So using all of those different things, I started doing these fractional acquisitions in order to build my own diversified portfolio so that it wasn't just the businesses that I was operating, okay? And as a result, whenever I buy a company, I'm putting in, like $100,000 to, $300,000, right? And so as I built this out, I was doing the same amount of money in each one of these things, okay, over a period of time. And ultimately, I have made just as much money on paper, okay, in this strategy as I have buying my own companies, okay? And, if people want to know, why I started doing this, it's because, look, guys, it's sort of like if you, if you got a keg of the best beer in the world and it was at your house and you're sitting there looking at the keg of beer, you're not going to say to yourself, well, I'll just drink all this myself. Your first thought is, who can I invite to, come drink this keg of beer with me, and we're gonna have a party. And that's what we're doing. We're having a pizza party, okay? So like, I started this disciplined approach in 2019, all right? And it was consistent, it was disciplined. More on that coming out. But ultimately, what I realized was every deal I do and every deal that's out there has some version of a capital stack. You've got the senior debt, the mezzanine, the preferred equity, and the common equity, okay? If you don't know this, it's a topic for a different time, but ultimately it lined up with, kind of analogous to what I was seeing with the different investments. It's like, oh, where am I in the stack, right? And so the stack is private equity, real estate, and credit funds. And it's got a very similar feel in terms of where the assets correspond with this. And so I placed Buy Then Build at the bottom because this is where the active is. This is your active job, and then your passive investments. And ultimately, rather than call it the capital stack, this, of course, is the wealth stack, okay? So Build Wealth started, and I couldn't call it supply, demand, imbalance because that's a terrible name, and also buildwealth.com was somehow available. Yeah, so anyway, for active, obviously we've got Acquisition Lab, okay? I'm the creator of the elite acquisition accelerator for acquisition entrepreneurs. Our members have done 400 million in acquisitions. This is Lucas Phillips. I was just with him last week in New York, and this is his third or fourth company and all the equipment that he bought. I saw this bad boy running, new video coming out soon. But then I started bringing out my #1 real estate team with AHM here in St. Louis. I'm a 15-minute drive from their entire portfolio. Often on the weekends, I'll get a coffee and just drive around and look at it. First we brought out a value add portfolio, and now we're building the largest mass timber building in the world in downtown West St. Louis. The portfolio is currently running just shy of 50% IRR. We're about 12 months in. In the largest mass timber, everyone's teed up to get about a quarter of their money at the end of this year as we break ground and move forward with that. Then we had OK Stone. So OK Stone Engineering, we ended up acquiring 6% of a $117 million company at that time. We as a group, 6%. It's up 63%, okay, in months, so on paper, okay? So it will be one of the largest 1% of companies in the world next quarter. So like, next month, I guess, is Q2. We're rapidly approaching it. They're on track for a public listing next year. So this is all just like exciting stuff. I introduced BuildFlow, which has in partnership with Aspen, which has 6 assets in the portfolio. We're currently running a 12.7% cash-on-cash run rate, paid monthly. This is obviously higher than if you went direct because it's special for our special group. Okay, so then this is kind of how this is what we've done, okay, over the last year. me and you. This is what we've built, is a portfolio of wealth stack assets together. And I'm just, this isn't like an annual report, but the other day I was just like, okay, what do these look like? Okay, and so you've got these are projected internal rates of return. Deal 1 is like 50%, deal 2 is 25 to 45, deal 3 was 30 to 35, deal 4 is 11 to 14, but no volatility, liquid, semi-liquid. This is great. And then I love this asset, by the way. And then today we're talking about, basically at base case we're looking at 32%. Admittedly, this isn't in the PPM, but saying 28 to 32 is just giving us cushion. And again, this would be like the second worst performance they've had in 4 decades. So it's like we've got a 24 to 37% internal rate of return just on these assets. And so, if you had a keg of the best beer in the world at your house, you want to invite your friends, and this is super fun. So what is Build Wealth all about? It's about working on amazing projects with great people and stacking cash, okay? What I want to do for this deal is I want to end up being the largest owner in this fund, outside of, Mahajer and, GPs, the GPs. And so ultimately, the goal here, guys, is that if we pool our money together and take out bigger chunks of these funds, then we end up getting more deals with better terms, and we get higher, frankly, it impacts this graph, right? That's how I got all of these things, guys. This isn't, just whatever. But so ultimately, I want to build a family office of the future, right? Where we're able to, find deals together and take out, higher returns because we're doing the deals that we want. And this started and still is hey guys, I'm putting my money in this. So like, if you want to come in with me, then let's go do it together, because I can think of, frankly, nothing more fun to do than that. So today we're talking about BuildEnergy. Okay, it's an upstream energy fund. So I'm putting it up here in the private equity section because it acts like private equity. You could call it a real asset and decide to put it in your real estate side, but normally that would be midstream or downstream. This is upstream, and so this has the higher returns that come with private equity-like investments, but it also has a lot of cash flow in the meantime, which is really easy to get patient with. Just before, look, at the end of the 19th century, late 1800s, this is a picture of a 25-year-old young man. And what I want to share with you is that the decisions that this 25-year-old man decided to spend his time on, the things that he looked past what was normal and popular and proven, the things that he decided, the decisions that he made 130 years ago, decide more about how the infrastructure is around you today than you can ever imagine, okay? The things that he has set up, the things that he has spent time on, and the things that we do today. This man created the 5-day work week. This man created the education system to be structured the way that it is. And this man created what ended up being the largest global infrastructure of energy in the history of mankind, okay? This is downtown New York in 1907, okay? And it's cool to look at this. Like, isn't this cool? Like, look at all these cars. And what's funny is I had another picture of New York in 1907 that had like no automobiles, right? And it was so cool, but I mean, I lost the point that I want to make, which is that most of these cars, 50% of these cars, 50% are run on steam. Guys, 50% of cars in 1907 were run on steam, just like locomotives, okay? And the Stanley Group here, like this was their big car. They actually had this, they were the most popular. They had the fastest land speed record at the time, which was 127 miles an hour. It wasn't this car. That looked more like, a canoe or something. But these steam cars were the things, right? But because this was sort of the incumbent, it wasn't the thing that was the most exciting thing, which was the future of transportation that everyone knew for certain, which was electric vehicles, such as this fleet of taxis in 1897 in downtown New York. The entire fleet of taxi cabs at the end of the 1800s was electric vehicles. Here they are, plugged in, like we would plug in today, okay? Gasoline vehicles, okay, they were dirty. They were unreliable. They were loud. What was happening at the time was gasoline and electric. I'm not going to rival them in terms of they were both around. They were both around, but they were not the incumbents. Okay, they were not the incumbents. That was steam. Today, okay, EV sales are surging. Automakers are pledging to go 100% electric. Governments are passing laws to phase out gas-powered cars, and investors are pouring billions into renewables, convinced that oil is dead. This is today. All right? Leading up to leading up to 1900, Nikola Tesla, okay, ended up coming to New York and worked for Thomas Edison. All right? This is Thomas Edison in front of his first ever electric vehicle that he built and brought to market. Okay? And it turns out Thomas Edison was a total asshole, and Nikola Tesla couldn't work with him, so he bounced. And after he bounced, he created the AC induction motor. Okay, so he had an AC motor. All right, and by the way, just to rewind for a minute, Edison had a DC motor. Okay, and so this was the AC motor that Tesla made. And a guy named George Westinghouse, okay, who, by the way, well, anyway, he licensed from Tesla this AC motor because he thought it was the superior technology that was going to beat this whole entire exercise. He was working on building an automobile. Westinghouse had steam automobiles at market, okay? But so what he did was he had these big generators running on the Tesla motor, okay, the AC motor, and you can see this guy right here. Where's the size? This is for scale, okay? Look at this. Look at the size of this generator, okay? And so ultimately, he was licensing this from Tesla, and while he was building a car, sort of came under attack by Edison and the other, electric vehicle owners out there. The thing with electric vehicles is that they were clean energy, okay? They were quiet, okay? And they were very clearly marketed directly at rich people, unlike today. If you go back to the Westinghouse generator, okay, and versus Edison's, AC and DC, the thing is this was the AC and DC battle was the sort of like, it was the first version of the Apple PC. It was the first version of the Beta versus VHS. What is going to be the thing? And this got so enraged that everyone was trying to figure out what is the technology that we're going to go to, right? And AC or DC became the biggest talk of the town. But quietly, 40-year-old Henry Ford started Ford Motor Company. He had two investors, one of which owned a coal company. But what he noticed was that gasoline was very affordable. Okay, no one used gasoline. We made kerosene out of it. It was kind of natural gas we would burn off, and we would just throw away gasoline. It was extremely scalable. Okay, and it was inevitable that this was the easiest thing to scale, okay? And so he made a radical bet on gasoline as the energy source for cars, okay? In 1907, steam was the incumbent. It was very well understood. Electric cars were the future. They were the status symbol, okay? And gasoline was dirty, it was inefficient, it wouldn't start in cold weather, and it lacked infrastructure. Like all of them, it lacked infrastructure, okay? But what Henry Ford saw, okay, was an abundance that everyone else was ignoring. It was cheap, it was scalable, and it was full of untapped potential. This was the everyman car, okay? Not the cars of kings and queens. The first service station came out in 1907. In 1908, Henry Ford released the Model T. And by 1925, the Model T was so mass-produced, it killed both electric and steam cars in one fell swoop. This became the dominant technology because Henry Ford bet on an energy source that everyone else was ignoring, that was hiding in plain sight, okay? Henry Ford made decisions in his late 20s, okay? He worked for Westinghouse. He worked for Edison for a bit as well. And it was along the way that he thought that steam engines made no sense for lightweight vehicles because the boiler was just too dangerous, is what he said. And he looked at electric and he said, well, first of all, there's no batteries that are light enough. Like they weigh like a refrigerator. It doesn't make any sense. And to build the infrastructure for, those electric, what are those things called? I can't think of the word, the trolleys or whatever, to do the cords for the trolleys, that infrastructure was way too expensive for what he saw. Imagine driving around today, okay, with those trolley rails everywhere. Like it just wasn't gonna work. So he made the decision to focus on gasoline when no one else was, okay? But the big innovation, okay, that Henry Ford made, it was not in gasoline, it was not in, the industrial structure that transformed schools and how we work and everything else, but it was actually the energy infrastructure that had so much tailwind behind it that it was unstoppable and eventually inevitable. Energy infrastructure changes much slower than energy. This is what I call the Rockefeller effect, okay? Look, John Rockefeller became the first billionaire ever in history, okay? But here's the thing, look at this man. Does he look like he speculates? This dude is very calculated, okay? He builds infrastructure. He built pipelines, refineries, and rail networks. He built the entire foundation of 20th century energy based on the scalable model that Henry Ford chose and was successful with the Model T, okay? Oil's dominance was locked in for generations by John D. Rockefeller. The infrastructure is simply too big, okay? And I don't care if, green energy is where we need to end up. It's just not where we are today, right? And so it's interesting to think that our brains think faster and adopt faster than our infrastructure, okay? iPhone replaced the BlackBerry in 5 years, okay? Who remembers the BlackBerry, right? So, Netflix crushed Blockbuster in under a decade. We've got, coal to oil took 50 plus years. Coal to natural gas took 40 years and still not complete. Natural gas is the cleanest, by the way. Then you've got nuclear energy, which actually is the best. But how do we not have another Chernobyl? 70 years, and it's still the future of what we're working on. Renewables, despite trillions in investment, are only about 12% of global energy after 20 years of effort and desire. At the risk of making an analogy, okay, that is a little too far of a jump, I'm going to go for it anyway. Blockbuster was sitting there very concerned about what's going to win, beta or VHS. And Netflix looked at this really quiet, underrated, dirty technology called the US mail. And by leveraging DVDs in the US mail, made the whole entire argument of beta and VHS completely irrelevant, right? And now we're all streaming anyway, so the mail's relevant too. But the point is that like technology moves faster, and sometimes leveraging the opportunities in the infrastructure that is so abundant and so quiet, that's where fortunes can be made, okay? 100 years later, oil and gas is still over 80% of the world's energy. Right here, this was the inflection point in 1910. This yellow line is steam cars. They were 80%, okay? They were 80%. What year is that? 1890, okay? That's what was driving around on the streets, okay? And then you had, the sort of, Tesla, I was going to say, the EVs, down here, but like merging, coming up. And, you've got to think that this line is too simplified, but, this should be a little more exponential. But the point is 1910, gasoline hit the inflection point and went up for the rest of the decade as everyone adopted it and everyone built the tailwind behind our energy infrastructure that exists now. We're trying to replace it, I get it, but like everything you hear is about green energy. 83%, this is like 2020, I think, 2022, okay, 83% is still carbon. You've got coal, natural gas, and oil, 83%, 17% non-carbon. So just think, Pareto principle, 80-20 rule. Okay, you've got some green in there, and it's growing, but we can't move fast enough. We cannot get rid of this infrastructure. This is where we are. Okay, so you've got, again, the red line is oil and gas, and the green line is renewables, and this is today, and that's the gap. That's the gap. All because this young man made a decision about what to focus on. Okay? Now, where else? What other people's decisions do we care about? How about Warren Buffett? He just about 4 months ago put $400 million into petroleum, okay, adding, okay, to his stockpile. We've got, okay, so now we're going to go back into some charts. Look, we touched on this chart, but the concept here is that supply is severely constrained, okay? This isn't, how do I say, you get it. Like we're depleting the oil that's there, and we're not making new investments. We've touched on this, where we've got, an 87.5% decline in private equity funding, okay, of these assets. Okay, it's going to get a little technical here, but bear with me, okay? Ultimately, where this slide is going is that, like the use of oil is highly correlated to GDP growth, okay? And so you've got this gray line right here is GDP at 0, and anytime it's above that, okay, that means it's growing. And you could see the average is about 3%, okay? The average is about 3%. And it's been 3%, like since 1965, okay? Except for 2 years, it's been positive since 1965, which is that chart. So you've got 2 years where GDP growth was negative. What does that mean, Walker? It means basically every single year GDP is up, okay? So, look, the oil demand to GDP, how much oil does it take to create $1,000 of GDP has gone down. We've become more and more efficient, but it hasn't reduced the correlation. We're still at 0.993, okay, 99.3% correlation, okay, to oil and gas. And so it's one of these where the point here is that there's a very high predictability in terms of the oil demand in the future. It's very highly predictable because we can look at the efficiencies that are gained as well as what the estimated GDP growth is going to be, okay? And as a result, it's really easy to figure out that, if we stay on about a 3% average GDP growth, by 2050, we're going to be at a 40% shortage. It's going to be a 40% increase from where we are today, okay? If you believe we're not going to fix the shortage that I've already shown you, okay, then you're going to be like 100, 100 barrels a day short, at least. This is from Exxon, okay? And so you've got the global outlook up here, and this is, 2050, 2030, okay? So by 2030, so the green is the supply with no investment. The light green, okay, is supply with new investments, and then you've got all the new resources and projects needed. Same with natural gas. Same with natural gas, okay? Okay, the demand for oil in the short term has gone down. It's because of our foreign demand of our oil has gone down. China and Europe are weak in demand, but our demand is strong. But the point is we know that the supply is constrained, and we know that there's limited drilling, and we're depleting. And so what this means is that the short-term price of oil does not match the long-term trends that are pointing to higher oil. What I'm trying to say is no one's figured this out yet, guys. Like the market is not efficient. This is an inefficient market at work right now. This is a great time to buy because we know that all of the tailwinds are going to push this up, okay? And if they don't worry. We've stress tested all in the model. So it is with great pleasure that I announce BuildEnergy Fund 1 in partnership with Aspen Funds and Mahajer Energy Advisors, okay? The investment strategy we've touched on, okay? We're going to buy existing producing oil wells that are already there. We've got 70 oil wells currently under LOI right now. Then we're going to be doing infill drilling. This is not wildcat exploratory. It's not off, in the water. This is going to be just incremental organic gains to the oil that we're buying. Okay. Then we've got maximization of total return to the investor, meaning we've got a 10-year time horizon on this fund, but the goal is to sell when the market turns around because we don't know when that's going to be. Okay. We don't know when that's going to be. So the key reasons to invest are, the experienced sponsorship team. Look, we've talked about Aspen and like how, they are, adding a lot of value. We've talked about Mahajer Energy and their 4 decades of experience doing exactly this, as well as their track record. We've got democratized access. So basically, just like I'm talking about with you guys about what we're doing at Build Wealth, this is one of these where when we join together and because of the Jobs Act, we're able to actually get better terms and huge institutional deals that you couldn't otherwise get until recently. And now together we're able to do it, which is super exciting. And then we've got cash flow and upside. So frankly, we don't care when Mahajer decides to sell because ultimately we're getting, on average, if they hold for a full 10 years, 30% cash on cash returns for 10 years until you get that multiple. So ultimately, you're getting cash flow in the meantime while we wait, okay? The tax benefits are good. Now, here's the thing. I talked at length with Ben Frazer about this, who, by the way, we're going to try to catch him and see if we can have a little Q&A. We're not going to open the chat because we had a technical issue with that last time. We will follow up and have that next week or soon. But we're going to try to catch him, and I'm going to ask him some questions about his experience here. He and I had a conversation about the tax benefits around oil and gas, and a lot of the deals out there, they're exploratory, wildcatting kind of stuff, and they lead with tax write-offs. And it's like, look, don't pay taxes, and like we might also make money. Our fund is the other way around. Okay, we're actually looking to make money, but because it's so capital intensive, all of the pass-throughs go directly to the investors. So all the taxes is going to be deferred, and the goal is that we're able to not pay taxes on any of the money that we're bringing in from this fund. It's not going to be able to be applied to your active income in this investment. And the problem that we're having in Fund 6 is that it's so profitable that we don't have enough tax write-offs to cover all the money we're getting. I'd rather have that problem. Contrarian thesis. Look, guys, we covered this. It's hiding in plain sight. Okay, this is the infrastructure that everyone's ignoring. This is the infrastructure that has a supply constraint. This is the infrastructure that has a huge demand. And we know in the next 5 years that we've got about 7.1 million barrels shortage. Okay, that's what's happening here. So co-investment. I am personally investing in this. I am going to personally invest 5 to 10% of this BuildEnergy Fund 1, me personally. On the Aspen side, they've put in, I'm not sure what I can say streaming on camera, but I know exactly how much they've put in, and it's a very healthy 7 figures. Mahajer as well has personally invested a very, very healthy 7 figures into this thing that they are the experts in, which is awesome. So all of the GPs that are involved here are like kind of backing up the truck on this opportunity, and I like to look for that kind of stuff. Okay, so we've got our own money. I'm investing in this fund, same as you, right there. So ultimately there's 4 key risks that we're looking at here, right? So number 1 is operator risk. So by focusing on non-operating working interests, okay, we're able to not have that risk with the operators. And so a lot of the operations goes out to publicly traded companies and people that are very well capitalized with decades of history operating this stuff. And we're really there to help mitigate their risk on any given project. Okay, that's what this all is, and also expand what they can do, right? So drilling. So drilling, we're really focused on the infill drilling opportunities, and Mahajer specifically has a team of geologists. I think he's a geologist and got his beginning that way. But I mean, they spend a lot of time making damn certain that there's oil where we're drilling before we do a whole bunch of capital investment into getting that in there because it's expensive, right? So we're not doing the wildcatting offshore stuff I think we got that. Environmental risk. So We're on the lower 48 states, okay, no offshore. And also Aspen in particular is very diligent on insurance coverage as a key part of everything that they're doing. And then we've got, oh yeah, commodity price risk. This is very interesting. With Fund 6, ultimately, what they're doing is they're hedging by buying futures on oil, and so ultimately they're covering any of the debt payment in the unlikely event that oil just, pun intended, tanks. Okay, we're going to have enough of a hedge in order to maintain our downside. Okay, so it's limiting our upside just a little bit. As you can see, we're not too worried about our upside, we hope. But ultimately, we're also being proactive in hedging that so that we're not caught out in the wind. We talked at length about Mahajar's track record. Here it is again, multiple of invested capital. This is where we currently are, 18 months in, basically a 15% gain in a 36% IRR and 15 to 17% cash on cash in direct deposits to my account for one, and hopefully yours very soon. These are all of the places where Mahajar Energy has been actively working over the last 40 years. These are all the locations that they have acquired, oil wells. Okay, so I love that they're this active. And then these are our operators, guys. Like, go look them up, on Yahoo Finance. Anna, I hope Anna's here. So like, check them out. Like, you can easily do, your diligence on all of these institutional grade operators. This is the current Fund 6. We raised $41 million. There's been 3 acquisitions, 183 producing wells, 5 drilling projects have started, 36% unrealized IRR, and the cash on cash return. So this is like the most recent sort of traction that we have. And actually, Fund 6 is probably going to participate in this new Fund 7 acquisition that we're doing here as well with the 70 wells. Okay, so this is the original fund setup and share class, okay? I want to focus your attention right here because this was the whole game. Ultimately, there is a family office purchase, okay? And with a $5 million investment, you can get a 15% discount on shares, okay? And by doing that, we at BuildEnergy are making this commitment. Okay, we're dropping the minimum investment to only $50,000, and then we're splitting the 15% discount. Okay, $5 million is what we're going for here. That's about in line with the last few raises we've done, but I'm going to talk about that in a second. And then our target IRR drops like 1%, the high end at 28 to 32%. Like I've touched on before, if this Fund 7 only gets a 32% IRR, I'm sorry, but it's well below average, and it's the second worst outcome in the 40 years thus far. So, I'm not trying to say there's no risk. I'm just saying, like, this is what's in the PPM, and, we're trying to be, sort of, realistic about what we think is achievable. And, once you start getting over these kinds of numbers, it's like, you need a lot of things to go right, okay? And that's kind of where we are, and that's what we're doing, and that's the structure. So $50,000 minimum, 7.5% approximate discount, and you make 7.5% the minute your money comes in because of that discount that we're able to carry forward. I'm going to touch for just a minute on projected returns. We've got a base case and a stress-tested case here, okay? So ultimately, if you invest $100,000 into this fund, okay, you've got years 1 through 10, you've got all the cash flow, and at the end of the day, it's totaling almost $1 million, 30% cash on cash if we hold it for the whole 10 years, net cash flow over $1 million, and then you've got IRR of 32.3. That is the base case in the PPM on our BuildEnergy Fund 1. Now let's stress test everything we can and come up with a downside case, okay? This is like we're looking at every single thing and saying, like, nothing works in our favor whatsoever, okay? If that's the case, okay, we're putting in $100,000 and we're getting out, 318, so you're looking at 4% cash on cash, okay? Net cash flow total of 318,000, so you triple your money, and an IRR of 13%, which, is about 30% better than the average stock market investment. So it's still a good investment. You might not just, so the point here is, if this looks like a good investment to you, then I think that if you can get comfortable here, then that's going to help you know, if this is a fit or not. Not everything that we're going to do is going to be, to like take home run swings. But so, this is with everything stress tested, that we could possibly think of, okay? Tax benefits, we've talked about, they're passing through, but this is a profit first fund, and it's not, we're not going with tax advantages first, right? Then we've got the whole pro forma. Let's go ahead and save this for you to sort of research later. But again, we touched on the revenue getting to exceeding 100 million in 2032, and this just it includes the net income. So just for fun, when we're at 132, we'll be at 40 million of net income. Okay. Now look, the last time that we came together and raised around a $100 million company, we took about 6% of the whole thing, and that's what I would like to do here. Okay. So let's see if we can do that. That's what I'm hoping we can do. But look, I mean, the point is that like this is not some kind of mispricing. This is not just mispricing that's happening in the market. Okay, this is a significant energy crisis that is a few years ahead of where we are, and the market hasn't priced it in, and that's what we're doing here. Okay, we're recognizing an opportunity, and if you're anything like me, you lay around at night and say, whoa, boy, I see this, but like, how do I make money on it? And this is how I've decided to make money on it. Please come join me because it's so much fun. Okay, so May 1st. Okay, guys, check it out. So here's the deal. It's like March, okay? With the agreement with the family office shares, okay, whatever we raise prior to May 1st is going to total 75% of our total amount. So in other words, I've subscribed to $5 million. Okay, if we can get $5 million subscribed into BuildEnergy Fund 1 by May 1st, it actually unlocks another 2.5 million bucks. Okay, that we can acquire. That would get us up to about 7.5 million on a $75 million equity raise. Okay, it doesn't translate to 10% because there's about 25% debt to make it a $100 million fund. But ultimately, I just would love nothing more than for us to take out like 7.5% of another $100 million fund, because that is fun to me. Okay, and I think that that'd be awesome. We will have a party in St. Louis. Okay, if we do that. So again, it's hung up in legal. The PPM is not 100% done yet. It should come in the next few days, but we are open for soft commitments. We are very much available for conversations. Reach out to Mike Brown. I'll give you his contact information in a minute. Mike@buildwealth.com is another way to get him. But this is kind of a now thing. I'm not saying you have to be fully funded by May 1st, but we need to have all commitments in, and I really want to get $5 million. Okay. So about the fund, 75% of capital will be defined by May 1st. Oh, the other thing I want to share, we'll talk to Ben in a minute. Hopefully we can catch him. I think that they've already raised like $30 to $40 million in this fund. And so this is the first day that I'm talking about this, not including my own investment in this fund. We already have over 10% of it full on soft commitments, and then I'm going to take personally another 5 to 10%. So, like, not to create urgency where there isn't any, but it's just sort of like a make a decision, go or no go right now, because I think that we're going to be able to fill this pretty quickly, and I hope that we can. So whatever we have on May 1st will define what 75% of our capital raise is. Okay. We'll be accepting subscriptions on a first come, first served basis. Capital will be accepted as acquisitions are made, and we may need to have a waitlist structure. Okay, so for this first acquisition, if in total we raise all of the amount, but like we don't necessarily need more than like that, the next tranche will have to wait. Okay, so the first year of the fund, all of the proceeds are being reinvested into new drilling so that we can expand the total value of this and the total income that it's generating. Okay. And then we're targeting distributions in year 2, and thereafter growing for the distance of the fund. In Fund 6, it came early. There's no guarantees on that. In fact, in a secret way, you kind of hope that they don't, because that means that we've got better drilling opportunities. Okay. If you are interested, talk to Mike. He's great. I'm getting texts all day long from our community saying like, Mike is so great. Mike Brown has come on as the investor relations at Build Wealth. He was the perfect fit for so many reasons. He personally has invested in everything that we've taken out. Not the first one, but only because he missed it. So this is his cell phone number, mike@buildwealth.com. Let's get on the phone and learn about, your objectives and what it is that you want to do. And then we can find, because we've got a portfolio, even if it's not this one, if you don't like to make a whole bunch of money and also cash flow, maybe we can find something else for you, right? But it's sort of like we need to figure out what your objectives are and what you're trying to do, rather than try to sell you on whatever fund we have right now. Okay, at the end of the day, Build Wealth is all about what is Walker investing in, right? Where's Walker putting his money and inviting our community in so that we can have a bigger impact and more fun together, okay? Thank you so much. We might have Ben Frazer here. We didn't do a tech check, so there's going to be a slight adventure piece component to this. Guys, is Ben here? Are we ready to go? Okay, I'm just going to walk over here, all right? All right, JT? Say yeah. Is this going to work?
Oh man, no tech check. A lot of
Ben,
risk.
Ben, you can hear me.
I can hear you. You hear me?
Yes, amazing. After last time, you can imagine how nervous I was. I was just like, remember we had the headphones, like I couldn't hear myself talking. It was amazing. Thanks for taking the time.
Made it happen. Awesome. Yeah, excited.
Awesome. Hey, Ben, my first question for you is, if you wouldn't mind, just sort of take the microphone for a while and tell me about Jeff Mahajer and how you met him, and how you guys got to working with him and all the rest of it. And I think it's important because I know he's local to Kansas City. For those that don't know, we're all Missouri boys here. But I know that known him for some time. He wasn't just some guy you found on the internet. And I think that story is really important.
Yeah. Yeah, exactly. We got interested in oil and gas several years ago, started investing in different projects, really because of the macro trends that you set out. I mean, it's pretty compelling when you see the supply and demand and kind of where the forecasts are going. We actually believe it's a generational buying opportunity right now. So then the next big question is, how do we find the right partners? Because as we started doing more in this space, we realized there's a lot of, I don't want to say bad actors, though there are some of those.
Yeah.
There's a lot of unprofessional people in this space that are, when oil and gas gets hot, people get excited about it and they go invest with these mom and pop operators who at best are just incompetent and sometimes are worse, where they actually fudge numbers, exaggerate, and gross up, the fees, everything that they're charging to insane numbers. And we've seen all this stuff firsthand. So as we've been doing all this research, we've been making our investments, we get connected through multiple connection points of mutual friendships to this guy, Jeff Mahajer, and his firm. And we actually had him engaged him to do an appraisal on the geology of one of the assets that we purchased in another fund. And through that, started building a relationship, and started meeting with him, very frequently, and found out just the pedigree that he comes from. His father was the one that started the firm 40 years ago. Jeff is a trained geologist. Their whole background as a team is geology and engineering. And they were doing advising, consulting for large corporations to make decisions on where to drill, where to invest capital. And then eventually we're like, hey, we're pretty good at this. We should start our own funds. And that's kind of what started the whole track record, which you showed. But from a personal standpoint, I'm very, very picky about who I want to work with. And so we actually spent about a year getting to know each other. I did weekly meetings, coffee, lunch, cigars, those kind of fun things, but took it very slow and really built a relationship. And, that was before we even launched the fund a couple of years ago. So it's been now, several years of working together. He is actually one of my favorite people to hang out with and enjoy spending time with. Um, he's been
He's
an
very
awesome partner, and obviously the track
yeah,
record speaks for itself, but the character, the communication, the transparency, the approach, all those things kind of come together and to me make it a great partnership. And to kind of round out, well, where does Aspen fit in the picture? The cool thing with how this all came together, which I didn't hear the first part if you touched on this or not, but all the money that Jeff's raised to date has really just been from family offices. That's his whole
that's
connection,
right.
right?
I forgot to talk about that. Yeah, please.
Yeah, he's only ever really raised from one or two big check writers in every fund. So what I said is, hey, what if we can work with our
Easy.
LPs?
Like, hey, I just need like 30 million, and they're like, great.
Yeah, exactly. And we have this network of awesome fund managers like Walker that we want to get more access to this because we believe it's a really big opportunity. And it was just a perfect kind of situation where he's not the marketer. He doesn't know how to go and raise $100,000 checks from people or $50,000 in this case. It's a lot of work. He doesn't want to do it,
Right.
but it makes sense, and we're aligned in that. And then we also get to vote on all the acquisitions and all the hedging, on asset management, on strategic decisions of the fund. So it's a true partnership where we're working together, and it's worked out really well.
Yeah, it's great. I also, I've looked at a lot of oil and gas, and I've got a lot of like you, Ben. Like there's like so many deals in my inbox that I just don't even have time to look at them. Like now they're coming to me at a rate that I'm just like I literally don't have time. But every time, and you and I have talked about this. It's like every time I'm looking at a lot of these oil and gas deals, there like there's nothing wrong with having like a depreciation sink or like a write-off sink, so where like
Sure.
I'm gonna, like get rid of my paying any taxes on my income. I get it, but I think that there's a strategy there that a lot of these funds kind of take as the lead approach. Whereas, I sort of already said this, so I was about to say, I don't know if I can say this on broadcast Zoom, but like the problem we're having in Fund 6 is it's generating so much money that there's not enough write-offs
Right.
to cover all the profits. So, I mean, like I'd rather have that problem myself. And so, yeah, just this is
Well,
a
it's a great point because I think they lead with that because if you ask the next logical question, which is, well, send me your track record of all the
right,
other drilling you've done, which I've done because I evaluate a lot of these guys. It's not as pretty as they want it to be, if they're
right,
even being honest. And that's the issue with that is you're going to have this super wide variety of outcomes. It could be you go get 100%, IRR. You can
yeah,
do that in oil and gas, but it's also possible you get a 0% IRR,
right.
right?
If I'm
And
selling tax
so,
write-offs, it's okay. Everyone,
yeah, there
everyone
you go.
got what,
Yeah.
everyone got what they just didn't get the gravy. You know what I mean?
They
Right?
didn't get the gravy. Yeah.
How much has
But
been raised so far for this fund?
say it again.
How much has been raised?
Yeah. So commitments, we're knocking on the door of 50 million, I think 3 weeks in. So well on our way to hit the 75.
Yeah, we've got about 15 to 20% of our $5 million subscription before even today. Just from people calling and talking about other funds. They're like, wait, what's happening? And so
Right.
we have soft commitments coming in, which is great. I'm asking that, just because I want people to understand that it's kind of a now decision. I remember this from the
Yeah.
last time too. It showed up and then it was sort of gone pretty quickly. Um, Let's see. How can we predict cash flow when most oil and gas investments are exploratory?
Yeah. Yeah. I mean, I think you hit on that a lot where we're
Yeah.
we're buying existing producing wells, right? So we have a really good sense of what the production is going to be. And the great thing with this is because the well's producing, the geology is all there, you can model with pretty high certainty what their production is going to be for the next decade or two, right?
Yeah.
So you can model that all in. You kind of build in a discounted cash flow, you know, prediction of what that could be based on current pricing of oil and gas. Here's the whole thing that I don't know if you fully made the the big stamp of
I know you came in a little late. It's okay. We reached out to
yeah,
you
so
late.
you might have, but the point I think is really important is all the projections that you saw, even in the base case and everything else, that does not anticipate oil prices being higher than they are today,
Right.
right?
Right.
So we don't want to build that in because we can't control that, but we think the upside's there. So, but we want to make decisions on what we know today. And as you mentioned, we do employ a hedging program on commodity prices so we can lock in those prices. Natural gas actually has gone up in price of about almost 95% in the past 4 months. So we just locked in some new hedges that are looking really good for Fund
Okay.
Six. So we can get some really great cash flow locked in. And so we have very high confidence on here's the production. We have pretty good confidence on here's what the price is going to be. We sell that production at because we're hedging a decent amount. And then the rest of the unhedged production, we're just riding the market. And we want some of that upside because we think it's there. But with a high level of certainty, we know a pretty good range of what cash flow is going to be.
Yeah. It's like, I've never been in a situation where I'm acquiring a small business and I'm going in knowing that the thing that we sell is expected to go up in value. Like that's never
Right.
happened to me before. So there's this whole other component of like, oh, yeah. Um, So, where were previous similar funds during the 2020 oil price crash? How was that handled, and how would a future crash be handled for this fund?
Yeah. Well, if it happens again, right? So in 2020, prices went negative for a day, which
Yeah,
is kind of hard to wrap your head around. But for one single day, you actually had to pay the midstream companies and the pipeline companies to take the oil and gas away from the well, right? So it was the opposite of what it should be. They should be paying you. So that was a big price shock. There was a huge amount of supply in the system at that point. So it just was a big supply glut, and the markets got way imbalanced. What happened from an opportunity standpoint was it was a great time to be acquiring. So they actually went into acquire mode.
yeah.
I mean, that was the fun that you showed, which is still unrealized, but they're tracking towards I think it's a 70% IRR. That's an average
So
annualized
fund,
return on a
fund
time
five,
weighted
right?
basis.
Fund
Yeah,
five in 2020,
but
right?
yeah, fun five.
Yeah,
So that's the kind of opportunity that could happen when those kind of price shocks happen. Now, we don't that could still happen, right? But the great thing is we have the hedging, so that reduces a lot of that risk. But the likelihood of that happening, we think, is much less than it was before because the incentives right now to do new drilling have been severely pulled back than what they were in kind of 2020 when it was, it really was drill, baby, drill. And Trump's kind of coming back and saying, hey, let's drill, baby, drill again. And all the producers are like, we did that. We didn't really like the outcome. And we also are getting our wrist slapped, from the environmentalists for doing more of this. So what's the incentive to us? They don't want to do it. So it's a very different market than it was, 4 or 5 years ago.
yeah. Let's talk about the life of the fund. It's stated at 10 years. How do we think about that? Like, I mean, I mean, how do we think about that?
Yeah. Well, if you like this fund, it's partly because you likely like the thesis of where do we go from here? Where's the opportunity in the long term? And I think that's where a lot of the value can get captured and created is buying in a good time now and selling at a really good time, down the road where the prices have more upside because of the supply and demand imbalance. So if that's the case, we can't control when the market's going to realize the investment thesis that we have, which is prices will likely be higher. We're likely entering into a potential energy crisis, and sellers of oil and gas are going to be the beneficiaries. So let's get on the right side of that crisis. Um, but we don't know when that will be realized in the market. We can't control the markets. These are global markets. So we want to have enough runway in the fund to have flexibility to be able to sell and exit the assets when it makes the most sense. But we also are opportunistic in that we don't expect to hold for 10 years just to hold for 10 years, right? So it's we want to have that flexibility. But if you look at the past history, most of the funds have been exited within 3 years or so. I can't guarantee that's the case for this fund. It might be a different environment, but we would anticipate holding for the full time, unless we're producing 20-30% net cash on cash returns. Who doesn't like that? So it's
Yeah.
there's kind of a
Oh,
at that
right.
point maybe it's you don't sell because it's too good of
Yeah.
cash flow.
Well, it's one of these where it's also it's a buyer's market, okay? And if we look at Fund 6, at least one of the acquisitions that we've done was from a private equity firm who basically made a commitment that they were doing an exit in 3 to 5 years. So they sort of needed to exit, and reallocate capital somewhere else because that was the sort of promise of the fund. And so
Yep.
presumably they were in the black because of, leverage, or I don't know what else they were doing, but so part of it is that. But on that point, could you talk a little bit about Fund 6 has had 3 acquisitions. Could you talk a little bit about, the sellers and what the seller profile is, and, maybe why they're selling or how we're able to pick some of these up?
Totally. Yeah, it's a great point. A lot of the funds that we're buying from are private equity funds,
Mhm.
and these private equity funds, they have defined lives of the fund, meaning at a certain point in time they have to exit. And that was kind of what was happening in the first 2 acquisitions, where they were a very large fund. This was kind of some of the legacy assets that they had not sold yet. They are actually a operator. They operate their own assets. This was kind of the remaining non-operated working interests they own. And they had opportunities on the fields that they operated that they wanted to reallocate capital to because it makes more sense for them. That's their core business. And so they basically said, hey, what do you pay for this? And we named our price. It was a good price for us. And for them, it was be able to finish the fund. And I think they made a good return as well. Um, but left plenty of meat on the bone for us to go and continue to develop and get really good cash flow at day one. So that was an external factor that was causing the decision to sell. I wouldn't say it was a distressed seller, but it was a defined extrinsic factor that was kind of putting pressure on them to sell. Similarly, in the third acquisition we made from a different seller, they were participating in lots of different wells. They had a big portfolio in a similar scoop stack region, and they had a $6 million AFE authorization for expenditure that they had to go fund on another project. They didn't have the liquidity for it, and they basically came to us because they knew we had cash and it was a good relationship that they'd known for a while. Said, "What do you want for $6 million?" It was literally the conversation. We said, "Well,
What do you got?
give us partial ownership in these 14 wells that we like, and we'll buy it at this price." And it was at that point in time of 25% unlevered, present value. That's our cap rate, was 25%, which is really really good relative to historical pricing. So that was the kind of thing where it was they didn't to them it was a small number, but they needed that number. And
Mhm.
we were able to be quick. We solved the problem, and we got a really good deal for that. So those are the kind of things we're going for. Is we don't want to go and bid on like on market, heavily marketed broker deals. That's not what we're going after. We're going through relationships, becoming a strategic partner for these types of funds, going after institutional quality, big opportunities, and not a lot of seats at the table. And so we get a good deal because of that.
Mhm. Do we have an LOI out right now for Fund 7? Meaning
Yeah,
this.
I'm glad you brought that up because I did want to clarify. We don't. So that we
Okay.
have we have an LOI. We don't have a signed purchase contract. So we have an LOI for
We're
sure.
under LOI. Correct.
Yes.
Thank you.
We don't have a signed purchase contract, and it's actually not 70 wells. It's 700 wells that we
Oh my
get
God.
ownership in. So we're pretty excited about it. We
Great.
expect to see the firm outcome within a
Oh,
week or
it's
two.
70 million. It's 70 million. No?
It's actually 85 million. Yeah.
Okay. I'm close. I'm in the ballpark.
Yeah,
No,
exactly. So,
the bank
but yeah,
underwriter.
so
But I'm
we're
you.
talking with them. We put a bid out. We're in discussions. We think we're really close. So it's not locked in yet, but
Yeah.
um, if it's not this one, there's lots of others out there that we're working on. So, but it fits the box. It's a great fairway type deal for us. A lot of upside in the drilling, so it really meets a
And,
lot of the
and
boxes.
frankly, when you and I met with Jeff Mahajer a couple weeks ago, I mean, my big question for him was, look, we've got this LOI, but what happens if this deal doesn't close, right? Because to your point, we're not
Right.
in a purchase agreement. And, his answer was very predictable. It doesn't matter if it's this deal or the next deal. It's the time is now. And so if it kind of to your point, if you believe in the thesis, which, I'm going to put it bluntly, all of the empirical evidence suggests this is a great time to be buying in oil and gas. And so that's what we're doing. And that's kind of what Jeff was saying back to me. Can you talk for a second about, people who are considering investing through self-directed IRA funds?
Yeah, and then this is probably one of the last questions I got. I gotta pick up a kid here soon,
I,
but
I do too.
um,
Dance. We have like 3 minutes to go get my daughter at dance. But yeah, thank you.
um, yeah, so you definitely can, and that would be a question that you'd reach out to Walker's team on, specifically with the custodian. You have to work with certain types of custodians. But from a tax consequence standpoint, you definitely it's eligible to invest through a tax deferred vehicle. The thing you gotta think about is there may be what's called unrelated business income tax, UBIT, that could be generated because we do anticipate using a small amount of leverage. Now we anticipate using about 25 to 30% on the high end. So we don't, if it did produce that income tax, that would expect it not to be very large relative to the investment amount that you make. So, what that means, you could talk with Walker and his team on the impact on that. From my standpoint, it's not a huge risk, but you got to understand the
Yeah.
implications of that.
The only reason I brought it up. I'm in Fund 6 in my Roth self-directed IRA as well as not. So for what it's worth, that's not advice. It's just a point of order. Ben, thank you so much. Being able to look, I'm just going to flatter you for a second. Not only have I, loved your mission and what it is that you guys do, and as I've gotten inside Aspen Funds and seen how you guys operate, it just gives me so much confidence, and I really enjoy seeing how you guys have structured everything. And the sort of cherry on top is that, like working with you, I think that your depth of knowledge, on diligence calls and things like that, you'll go from being very conversational to extremely deep down into the engine and talk extremely knowledgeable about specific cells, in an underwriting model. And it's kind of blown me away. And so like the level in which you understand the things that you're a GP in, frankly, has been surprising to me based on working with other people that operate both businesses and funds. And so just want to throw you a little flattery that way. And share that with our community. So thanks for taking the time. And
Yeah.
soon. I'll see you in Colorado
All
next week.
right. Well, thanks, Walker. So appreciated and super excited for you and all the investors to participate with us in this. I think it's going to be a great partnership and a really great opportunity. And yeah, the momentum's there. So if you're interested, definitely reach out to Walker and his team. We've got spots filling up. We've got a couple of our share classes already full right now, or there's not even any room left. So this is really the only way to kind of get in. So yeah, exciting stuff. So thanks so much for bringing me on, Walker, and looking forward to talking more.
Thanks, Ben. Talk soon, man.